On the morning of January 7, 2009, the global financial community was confronted with an impossible mathematical reality. A company celebrated as the crown jewel of India's booming technology sector possessed $1.04 billion in cash on its balance sheet. Yet in the physical world, that money simply did not exist. It was a phantom fortune conjured from thin air by the very man who had built the empire. This was Satyam Computer Services, a titan of the outsourcing revolution that had transformed the global economy. At its helm was Ramalinga Raju, a visionary founder who had guided the enterprise from a modest venture into a multinational powerhouse. For years, the firm stood as a beacon of emerging market success, attracting elite clients and institutional investors worldwide. But behind the gleaming glass facades of its corporate campuses lay a labyrinth of deception so profound it would permanently fracture the trust of the international markets. The genesis of the fraud was not a sudden, malicious heist, but rather a slow, agonizing descent into systemic fabrication. In the late 1990s, as the technology bubble inflated, the pressure to demonstrate relentless quarter-over-quarter growth became an existential mandate for publicly traded firms. The founder, determined to maintain the narrative of an unstoppable corporate juggernaut, began making marginal, unauthorized adjustments to the company's financial statements. It was the classic rationalization of the white-collar executive, framing the manipulation as a temporary bridge of inflated revenue to cross a brief operational shortfall. However, the operational shortfall was never temporary, and the bridge soon required massive structural reinforcement. To sustain the illusion of exponential growth, the deception evolved into a highly industrialized operation hidden deep within the company's infrastructure. The primary mechanism relied upon the generation of fake invoices, a tactic designed to artificially inflate the company's reported sales. A secretive cell within the finance department, operating under direct executive instruction, utilized administrative super user passwords to access the company's enterprise resource planning software. By bypassing standard internal controls, this shadow team injected thousands of fictitious sales records directly into the official accounting system. They created a veneer of booming, profitable client relationships that were entirely fabricated, generating millions of dollars in imaginary revenue every quarter. Recording fake revenue inevitably creates a corresponding problem, as the balance sheet must show the cash received from those imaginary sales. To resolve this glaring discrepancy, the conspirators engaged in the systematic forgery of bank statements. They utilized simple graphic design tools to alter genuine documents from respected financial institutions, artificially inflating the balances to match the fictitious revenue generated by the software manipulation. These forged documents were then seamlessly integrated into the official financial records, presenting a portrait of a company flush with liquid assets. The anatomy of the deception then extended beyond mere revenue manipulation, encompassing the systematic siphoning of actual funds through the creation of ghost employees. Satyam reported a workforce significantly larger than its actual physical headcount. The salaries allocated to these thousands of non-existent workers were systematically diverted into hidden accounts controlled by the conspirators. This dual-pronged approach allowed the perpetrators to simultaneously inflate the company's perceived market value while quietly extracting its actual operational capital. Such a colossal, multi-layered fabrication should have been detected immediately by the safeguards inherent in modern corporate capitalism. Yet, the gatekeepers failed spectacularly, exposing a critical vulnerability in the global financial system. PricewaterhouseCoopers, the prestigious global accounting firm tasked with auditing the technology giant, repeatedly signed off on the fraudulent financial statements year after year. The auditors relied heavily on documents provided directly by the company's management, failing to independently verify the massive cash balances with the banks themselves. This critical lapse in professional skepticism transformed the rigorous auditing process into a dangerous illusion of security. The systemic failure extended upward to the highest echelons of the company's leadership structure. The board of directors, populated by esteemed industry veterans and respected academics, failed to exercise meaningful oversight over the executive team. The fundamental concept of corporate governance, designed specifically to protect shareholders from executive overreach, proved to be entirely ineffective. The board accepted the management's financial presentations without aggressively challenging the underlying data, blinded by the founder's charisma and the company's soaring stock price. As the years progressed, the gap between the company's actual financial health and its reported figures widened into an unbridgeable chasm. The fictitious assets grew so large that they became a gravitational anomaly on the balance sheet, mathematically impossible to ignore and increasingly difficult to manage. The architect of the scheme found himself trapped in a compounding cycle of deception, where each fabricated quarter required an even larger fabrication the next, just to maintain the baseline illusion of stability. The sheer scale of the lie had outgrown its creator, transforming from a desperate strategy for corporate survival into an autonomous, destructive force. Facing the imminent collapse of his fabricated empire, the founder attempted one final, audacious maneuver to fill the billion-dollar hole. In late 2008, he proposed that the technology firm acquire two infrastructure and real estate companies, Meta's Infrastructure and Meta's Properties. These entities were not chosen at random. They were controlled by the founder's own family members. The strategy was a complex form of asset substitution, a desperate attempt to swap fictional wealth for tangible property. By using the supposedly vast cash reserves to purchase real estate from his family, he hoped to quietly replace the forged cash on the balance sheet with actual physical assets. It was a staggering gamble, and it failed catastrophically upon contact with the public markets. The proposed acquisition, a blatant related party transaction, triggered an immediate and ferocious backlash from institutional investors around the globe. Wall Street analysts and domestic shareholders alike recognized the deal as a massive, inexplicable destruction of shareholder value, demanding its immediate cancellation. The sheer arrogance of the maneuver shattered the illusion of the founder's infallibility, prompting intense, unprecedented scrutiny into the company's underlying financial rationale. With the real estate escape route permanently closed and the regulatory scrutiny intensifying, the burden of the deception became entirely unsustainable. On January 7, 2009, Ramalinga Raju transmitted a devastating, multi-page letter to the Board of Directors, the Securities and Exchange Board of India, and the global financial media. In a few stark paragraphs, he completely dismantled the empire he had spent decades building, formally confessing to the systematic inflation of profits and assets. In his written confession, Ramalinga Raju described his agonizing predicament with a chillingly precise metaphor, stating he was riding a tiger, not knowing how to get off without being eaten. The immediate aftermath of this admission was an unmitigated financial bloodbath. Within hours of the letter's release, the company's stock price plummeted by nearly 80% on the open market. Billions of dollars in shareholder wealth were incinerated in a single chaotic trading session. The shockwaves rippled through the global markets, triggering an immediate crisis of confidence in the entire Indian outsourcing sector. Investors worldwide began questioning the integrity of financial reporting across emerging markets, wondering how many other supposed corporate miracles were built on a foundation of forged documents. Investigating the wreckage required a mobilization of regulatory power on an unprecedented scale. The Central Bureau of Investigation and the Serious Fraud Investigation Office descended upon the corporate headquarters in Hyderabad, seizing massive servers, external hard drives, and mountains of physical documents. The authorities faced the monumental task of disentangling a decade's worth of intricate, highly obfuscated financial engineering. To achieve this, the investigators deployed advanced techniques in forensic accounting, a specialized discipline that integrates investigative skills with deep financial expertise to uncover hidden illegal activity. The forensic teams meticulously reconstructed the company's true financial history, tracing the hidden digital footprints of the fake invoices and cross-referencing the forged bank statements with actual banking records. The resulting portrait was one of systemic, deeply embedded corruption that had infected every level of the financial reporting apparatus. Beyond the staggering financial metrics and regulatory violations lay a profound, often overlooked human tragedy. Tens of thousands of employees who had dedicated their careers to building what they believed was a world-class organization suddenly found themselves tainted by association. They faced an incredibly uncertain future, their professional reputations becoming collateral damage in a massive fraud they had absolutely no part in orchestrating. The psychological toll of realizing that their daily labor was predicated on a fundamental lie was immeasurable, creating an atmosphere of profound betrayal and anxiety. The devastation extended far beyond the corporate campus, reaching the retail investors who had entrusted their life savings to the company. Pensioners, small business owners, and ordinary citizens had purchased the stock based on the audited financial statements, deeply believing in the rigorous oversight of the regulatory system. Their financial security was obliterated overnight, underscoring the devastating real-world consequences that inevitably follow unchecked white-collar crime. Recognizing the severe systemic risk posed by the company's imminent collapse, the Indian government orchestrated an unprecedented emergency intervention. To prevent the catastrophic loss of tens of thousands of jobs and to salvage the international reputation of the vital IT outsourcing industry, authorities immediately superseded the disgraced board of directors. They appointed a new panel of highly respected industry leaders tasked with stabilizing the firm's operations and finding a viable buyer. This rapid stabilization effort culminated in a highly scrutinized public auction, resulting in the acquisition of the battered company by Tech Mahindra. It was a rare, complex instance of a successful corporate salvage operation in the immediate wake of a massive financial fraud. The acquisition successfully preserved the core operational capabilities of the firm and protected the livelihoods of the majority of its workforce, though the original corporate entity as it was once known ceased to exist. The reckoning for the corporate enablers was severe, fundamentally altering the landscape of financial compliance. PricewaterhouseCoopers faced intense regulatory scrutiny, massive financial settlements, and a profound loss of professional prestige. The Securities and Exchange Board of India eventually banned the firm's network from auditing listed companies in the country for a period of 2 years, a stark reprimand that sent permanent shockwaves through the global accounting profession. The legislative response to the crisis was equally profound and far-reaching. The scandal catalyzed a sweeping overhaul of India's corporate legal framework, ultimately culminating in the stringent new provisions of the updated Companies Act. The reforms mandated enhanced financial disclosures, significantly strengthened the legal responsibilities of independent directors, and established a powerful new regulatory body specifically focused on overseeing corporate financial reporting. As for the architect of the deception, the wheels of the justice system ground slowly but inevitably forward over the ensuing years. Following complex litigation and exhaustive evidentiary hearings, a special court convicted the founder and his key co-conspirators of criminal conspiracy, cheating, and forgery. The sentencing marked the formal legal conclusion of the saga, yet the shadow of the unprecedented deception continued to loom over the global corporate landscape. The Satyam Computer Services scandal remains a definitive, chilling case study in the anatomy of corporate fraud. It serves as a permanent, undeniable reminder that the most dangerous financial threats often do not originate from external market forces, but from deep within the executive suite. The illusion of success, fueled by relentless market pressure and enabled by complacent gatekeepers, can sustain a fabricated reality for a shockingly long time. Ultimately, the unraveling of this billion-dollar deception exposes the incredibly fragile foundation upon which all modern financial markets rest, which is absolute trust. When that fundamental trust is systematically exploited by the very individuals entrusted to safeguard it, the resulting collapse destroys far more than just financial capital. The phantom fortune of 2009 has long since vanished, but the dark lessons extracted from its creation remain a vital, enduring warning to the entire global financial community.